Picture this. You're sitting at a kitchen table. Maybe it's yours, maybe it's your parents'. There's a laptop open, you've just spent 45 minutes on Zillow and you've found it. The house. 3 bedrooms, 2 baths, decent neighborhood, not too far from work. The price tag says $499,000, just under the psychological cliff. You feel something, hope maybe, or something that used to be hope. Then you click the mortgage calculator, and that feeling disappears. Because the number that comes back, the monthly payment, is not a number you were prepared for. It's not a number that fits inside your salary. It's not a number that fits inside most salaries. And yet, that house exists. Someone is going to buy it. The question is, who exactly? Because it's probably not who you think, and it's probably not for the reasons you've been told. This is the math behind a $500,000 home in 2026. And by the end of this video, you're going to understand exactly why the housing market feels like it was designed for someone else. Because in a very real sense, it was. Let's go back. Not far, just a few years. In 2020, the average 30-year fixed mortgage rate in the United States was hovering around 3%. That sounds almost fictional now, but it was real. And at 3%, a $500,000 home with a 20% down payment, so a $400,000 loan, cost you about $1,686 a month in principal and interest. That's it, $1,686. Not cheap, but manageable for a household pulling in $80,000 or $90,000 a year. Tight, yes, but not impossible. Now it's 2026. Rates have come down from the peak of 2023, but they haven't come back to where they were. The average 30-year rate is sitting somewhere between 6.5% and 7%, depending on your credit, your lender, and the particular Tuesday you walk in the door. Let's call it 6.75%, which is about as generous as the market is giving you right now. Same house, same $500,000 price, same 20% down, same $400,000 loan. Your monthly payment, principal and interest only, is now $2,594. That's a difference of roughly $900 a month compared to 2020. Over the life of a 30-year loan, you will pay approximately $330,000 more in interest than someone who bought that same house 5 years ago. $330,000 for the same house, just bought at a different time. That's not a gap, that's a chasm. But here's where it gets worse, because the mortgage payment is just the beginning. When lenders decide whether to approve you for a loan, they don't look at your mortgage payment in isolation. They look at something called your debt-to-income ratio, or DTI. The standard rule, the one that most conventional lenders use as their ceiling, is 43%, meaning your total monthly debt obligations should not exceed 43% of your gross monthly income. Now, your mortgage payment isn't just principal and interest. It includes property taxes, homeowner's insurance, and if your down payment is less than 20%, private mortgage insurance, or PMI. Let's add those in. Property taxes vary wildly by state, but the national average on a $500,000 home is somewhere around $6,000 to $8,000 a year. Call it $600 a month. Homeowner's insurance may be $150 a month. If you put exactly 20% down, you skip the PMI, but you had to come up with $100,000 in cash first. We'll come back to that. So your total monthly housing payment, being conservative, is somewhere around $3,344 a month. To keep that under 43% of your gross income, and remember, this is the absolute ceiling, not the comfortable zone, you need to be earning at least $7,777 a month before taxes. That's $93,333 a year gross. Most financial advisors will tell you that 43% DTI is the danger zone, not the goal. The old guideline, the one that was standard before the everything is fine era of loose lending, was 28% of gross income. At 28%, that $3,344 monthly payment requires a gross income of $11,943. That's $143,314 a year. The median household income in the United States in 2026 is approximately $80,000. So at the comfortable, traditional standard, you need to make nearly twice the national median to responsibly afford a $500,000 home. Sit with that for a second. Now let's talk about the down payment, because this is where the conversation usually falls apart. 20% of $500,000 is $100,000. Not $100,000 in net worth, not $100,000 in investments, $100,000 in cash or liquid assets that you hand over at closing, never to see again. Plus closing costs, which typically run 2% to 5% of the loan amount, so add another $8,000 to $20,000 on top of that. You're walking in the door needing somewhere between $108,000 and $120,000 ready to go before you own a single square foot. How long does that take to save? The average American saves somewhere between 5% and 8% of their income per year. On an $80,000 salary, that's $4,000 to $6,400 a year. At that rate, saving $110,000 takes 17 to 27 years. And that assumes the price of the house doesn't increase while you're saving, which it will. Because while you've been diligently putting money away, home prices have continued to climb. Not everywhere, not uniformly, but on average, residential real estate has appreciated at roughly 4 to 6% annually over the past several decades. That $500,000 home you're saving for is, 5 years from now, likely a $600,000 home. And the finish line just moved. There's a name for this dynamic. Economists call it the affordability trap. The more you save, the further away the goal gets, because the asset you're saving for is itself compounding faster than your savings rate. It's like trying to catch a train by jogging. So who's actually buying? This is the part of the story nobody puts in the headline. The profile of the American home buyer has shifted dramatically over the last decade. First-time buyers, people purchasing their first home, have dropped to near historic lows as a share of total purchases. According to the National Association of Realtors, the median age of a first-time buyer is now 38 years old. In the 1980s, it was 29. 9 years. 9 years of life that have been consumed by the waiting room of homeownership. The buyers who are actually clearing these hurdles tend to fall into a few distinct categories. The first is the dual-income, no-kids household, sometimes called DINKs, where 2 professional salaries combine to clear the income threshold. 2 people, each earning $75,000 a year, get you to $150,000 combined. That clears the traditional 28% guideline with room to breathe. It's still hard, but it's doable. The second category is the equity ladder climber. This is someone who bought a home in 2018 or 2019, watched it appreciate by 30%, 40%, sometimes 50% during the pandemic era, and is now using that equity as a down payment on the next house. They didn't time the market with genius, they were just already in it. The market rewarded them for being there. The third category, and this one is growing, is parental transfer, gifts from family. A 2023 study found that more than 25% of first-time buyers received financial help from their parents for their down payment. That number is almost certainly higher now. The bank of mom and dad has become a structural feature of the American housing market, not a footnote. And then there's a fourth category that doesn't get talked about enough at dinner tables, but gets talked about a lot in real estate circles. Institutional buyers, investors, and cash purchasers. In some markets, cash buyers account for more than 30% of transactions. These are people or entities for whom the mortgage rate is irrelevant because they don't need a mortgage. They're not competing on the same terms as you are. They're not even playing the same game. Now here's the piece that makes the whole thing feel slightly surreal. The housing market, as painful as it is for buyers, has largely been fine for the economy, at least on paper. Homeowners have seen their net worth climb. Construction in certain markets is up. Prices in some overheated areas have cooled slightly. But underneath the surface statistics, something structural is shifting. When housing becomes the exclusive domain of dual-income professionals, equity inheritors, and institutional capital, you don't just have a housing problem, you have a wealth stratification problem. Because housing has historically been the primary mechanism by which middle-class American families built generational wealth. It was the savings account that also gave you a place to live. It was the retirement plan that sat beneath your feet. If that mechanism is broken, or more precisely, if access to that mechanism is now determined largely by whether you were already wealthy or lucky enough to be already in the market, then the implications don't stop at real estate. They ripple into retirement security, into geographical mobility, into class mobility, into the very definition of what the middle class is. A renter doesn't build equity. Full stop. A renter may be perfectly comfortable, perfectly happy, financially responsible in every way, and at the end of 30 years, they have zero ownership stake in the asset they've been paying for. The landlord does. This is not a moral argument about renting versus owning. It's a mathematical observation about how wealth compounds and who is positioned to benefit from it. Now let's introduce one more variable, because the picture isn't quite complete without it. Student loan debt. The average borrower in the United States carries roughly $37,000 in federal student loan debt. For graduate degree holders, lawyers, doctors, MBAs, the very people whose incomes might otherwise qualify them for a $500,000 mortgage, that number climbs to $80,000, $100,000, $150,000. Remember the 43% DTI ceiling? Every dollar of monthly student loan payment eats into that ceiling. A $600 monthly student loan payment reduces your maximum allowable mortgage payment by $600. That doesn't sound catastrophic until you realize it can knock $100,000 off your buying power. So here's the brutal version of the math assembled. You need roughly $143,000 a year in gross household income to comfortably afford a $500,000 home. You need $110,000 to $120,000 in liquid cash for the down payment and closing costs. If you have student loans, add a haircut to your buying power. If you're a single earner, it gets harder. If you're in a high cost of living city, which is often where the jobs that pay $143,000 a year actually exist, the $500,000 home is not a suburban 3-bedroom. It's a small condo or a fixer-upper in a neighborhood your GPS hesitates before routing through. The math isn't just hard, the math is structurally exclusionary. Now, is there a version of this where things get better? Theoretically, yes. Rates could fall, supply could increase, especially if zoning reform takes hold in enough cities to matter. Remote work could sustain demand for lower-cost secondary markets. Home prices in some overheated areas have already started to correct modestly. But theoretically, yes, is doing a lot of heavy lifting in that paragraph. The structural forces keeping housing supply constrained, zoning laws, NIMBYism, construction costs, permitting timelines, don't move fast. They don't respond well to urgency. Cities that have tried to accelerate housing supply have learned that building is slow and political resistance is fast. And rates? The Federal Reserve does not set mortgage rates. It influences them. And the factors that would bring mortgage rates sustainably back to 3%, low inflation, low growth, a certain kind of economic stress, are not exactly conditions most people want to wish for. So the scenario where a $500,000 home becomes broadly affordable again isn't impossible, it's just unlikely in any time frame that matters to someone who is 35 years old right now, has a good job, and is watching their friends get priced out of the cities where they built their lives. Now here's what I want to leave you with. The $500,000 home is not a luxury home. Not anymore, not in most American metros. It's a median-adjacent home. It's the place you'd raise a family and park a used car and call a win. And that home, that ordinary, achievable-sounding thing, now requires an income and a savings stockpile that puts it firmly out of reach for the majority of American workers. We haven't had a real national conversation about what that means. We talk about it in terms of affordability indexes and rate cycles and market corrections. We frame it as a temporary distortion that will eventually normalize. But what if it doesn't normalize? What if this is the new geometry of American wealth? What if the defining financial experience of a generation isn't buying a home, it's deciding slowly and reluctantly, and without quite saying it out loud, that you're probably not going to? The math, as I said at the start, is brutal, but the math is also honest. And maybe the most important thing you can do with brutal honesty is stop waiting for someone to tell you it's going to be fine and start making decisions based on what's actually in front of you. Because the house doesn't care what year you thought you'd buy it, and the bank doesn't either.